Hello, everyone. Welcome back to another presentation. Today, we're talking about the Zacks Earnings Certain Portfolio. This is our flagship model portfolio that we offer. And today, we're going to be talking about the strategy, its performance, and some of the key holdings that make up this portfolio. So let's get started. So first, we'll talk about the strategy. And what is the strategy? In a nutshell, it's simply 3 steps. Buy quality, don't overpay, and do nothing. This is the classic value investing approach that titans such as Warren Buffett, Charlie Munger, Peter Lynch, and others have talked about over the decades, is to focus on quality. And so how do we define quality? Let's take that next step. The way we define quality is this 3-step approach. We're looking for, first and foremost, companies that have delivered consistent earnings per share growth over a very long period of time. Typically, we like to look for companies that have delivered consistent earnings growth over 20 years' time, because that gives you full exposure to multiple market cycles, various different macroeconomic environments, different interest rate regimes, different periods of strong dollar versus weak dollar, and other factors that the entire U.S. economy has lived through for that entire time period. So we want companies that can deliver results consistently in every type of environment that we've been through. So that's the first step that we take. We also want to look for companies that have consistent cash flow growth. So remember, earnings growth is great, but earnings without cash flow is a red flag on the quality and sustainability of those earnings. So we want to look for cash flow, strong cash flowing companies as well. Thirdly, we want to focus on companies that can generate and can consistently generate attractive returns on invested capital. That's ROIC. This is a very, very critical concept for long-term investors because this is how we outperform the market. You invest in companies that can achieve consistently high results or high returns on capital over time. That will lead to faster earnings per share growth because this is what we call the classic capital compounding effect. Companies that generate good returns can then reinvest those cash flows back into themselves at a high ROIC and therefore compound earnings growth over time. So we want not just consistency in earnings per share growth, but we want companies that can reinvest those cash flows, those earnings back into themselves at very attractive ROIC. That's how you achieve faster cumulative earnings growth over time. So these 3 principles are made possible because we're picking companies that have durable business models. And by durable, we mean, their revenue is unaffected mostly by macroeconomic inputs. We have companies that do quite well for a couple of years because they might be a fad. We have companies that do quite well for a couple of years because they have favorable tailwinds from the macro environment. When interest rate spreads are high, banks do well, but when they're not, they don't do well. When commodity prices are high, energy stocks do well. When commodity prices are low, they don't do so well. So we want to avoid those types of cyclicality in earnings. We want companies that have consistent results because their businesses are durable, meaning they produce products and services that are always in demand. We like to look for companies that have, consistency in earnings, but it's because what they make is always in demand by customers and by businesses that consume their products and services. So we focus on companies that produce needs, not necessarily wants. Or we want to focus on businesses that produce things at a cheaper cost compared to the existing, product or service that's out there. Or we want companies that are maximizing pleasure or maximize utility. So there has to be some value add that the business provides, and there has to be evidence that this has been durable over time. Companies that can do this over a long period of time demonstrate, or at least points towards the idea that there could be a established brand or economic or other R&D moat, right? And that's very, very important to achieve excess returns over time. Is companies that have that consistency and durability with regards to their business model. So the key word here is consistency, right? We want to look for consistent results. We don't really mind if they don't grow at eye-popping rates year over year. But what we want is consistency, because slow and steady wins the race. It's the classic tortoise versus hare fable that we all know about and have heard about. And so that's what this is right here. We can see the actual results. So this chart right here shows you the historical earnings growth of this portfolio over time. So here in this orange dotted line, this is a depiction of the actual earnings per share growth over time of the 75 companies that comprise the earnings certain portfolio. This is exactly what we like to engineer. This is the goal of the portfolio. You can see through the shaded regions, those are the recessionary periods, and they have delivered growth even through those very, very turbulent times. We saw during the dot-com bust of 2001, this group of companies, basically acted like nothing even happened in that time period. We went through the great financial crisis where banks were going under. We had over 100 banks fail in that 2-year period or 3-year period. And the companies within this portfolio just continue to deliver earnings growth even during that volatile period of time. Same thing with the COVID disruption of 2020. We saw a brief sort of hiatus followed by a resumption of growth. And so we of course expect that going forward as well, even through the next recession, which we're sitting here in the middle of 2022 right now. And calls of recession are growing. That chorus is getting louder and louder by the day here. So this is exactly the type of environment that the earnings certain portfolio does quite well on. So we'll see here in just a second here exactly how well we do, but this is a portfolio that's truly engineered to be recession resistant. And so by playing defense, we believe we will beat the market over a complete market cycle. We'll take a look a little bit about in terms of performance in just a minute here. But one thing about this that I will note is that, consistency is one thing. That's one part of the overall idea. But remember, the third principle in our approach is we want companies that can consistently generate attractive returns on invested capital. Because if we just focused on consistency, well, guess what? Utilities are very consistent, right? If you were to just invest in utilities, you'd basically achieve this type of consistency, because utilities are always in demand. And as long as there is a population, there will always be demand for electric utilities as well as natural gas, or basic amenities for the household. So that's only one part of it, right? Consistency is one, but we also want consistently attractive ROIC. And utilities have consistency, but they have very poor ROIC. They are very capital intensive, and their returns on invested capital are often 1 to 2%, which means that their cumulative earnings growth is very, very low. So this is what this chart shows us, is that not only does the earnings certain portfolio provide consistency in earnings growth over time, but it also has faster cumulative earnings growth versus the S&P 500, versus utilities, and versus a basket of stocks that we've also created here called the cyclicals, the tactical tilts is what we call it. This is a basket within the S&P 500 that represents essentially energy and financials. Because remember, energy and financials do not exist in the earnings certain portfolio. Why? Well, you can see right here, because they have very high volatility in earnings. Energy and financials do quite well during boom periods, and then they really fall hard during recession. And so they are very, very sensitive to macroeconomic inputs. So we want to remove that sensitivity to the macro environment. That is our goal with the earnings certain portfolio. We want to invest in companies experiencing secular growth. These are companies that produce products and services that are always in demand, and companies that are able to consistently reinvest cash flows back into themselves at a high ROIC, and that is what leads to this compounding effect that you see here. So straight up, in a way, the earnings certain group of companies not only produces better consistency in earnings growth, but also faster cumulative earnings growth. Because remember, if you reinvest back at high ROIC, what that does is that it compounds your growth rate over time. And so that is exactly how we intend to beat the market, is through that compounding effect. So remember, you can get consistency by just simply investing in utilities. You can see that line right here. It's this purple dotted line. That has very consistent earnings growth, but you can see the cumulative earnings growth over time is very, very low. In fact, it's even lower than cyclicals, which are highly volatile. So here you have the S&P 500 cumulative earnings growth. They've basically multiplied earnings by about 6.5 times over the past 25 years. Cyclicals, meaning energy and financials together, have grown or compounded earnings by about 4.5 times over 25 years. Utilities have multiplied 3.5 times over 25 years. And the earnings certain 75 companies have multiplied their earnings by almost 17 times over the past 25 years. So better earning stability, faster cumulative earnings growth versus the S&P 500. This is the buy and hold approach that we believe will outperform the S&P over time. So that is the idea behind the earnings certain portfolio. Now let's take a look at what you get with the S&P 500. What is so wrong or so bad about being an index investor? Well, one, being an index investor means that most people are buy and hold only. So most people who are invested in the S&P 500 index fund are buy and hold. They, add to their position through dollar cost averaging. They consistently contribute, every single month or every pay period. And that's fine, right? Because it will compound, as we saw over time. It does compound quite well. It has grown by 6.5 times. But the problem with being a long-term S&P 500 index investor is that, the index is a hybrid of two categories of companies. One is that half of the index are cyclicals. These are mature businesses, right, whose revenue and earnings rise and fall with the broader economic cycle. Essentially, this basket right here, the second group that I highlighted here, this is the Zacks Tactical Tilts, which is essentially just energy and financials. So if we were to strip out the energy and financials, they actually do worse than the S&P 500 overall, right? And it's because the S&P 500 overall is a hybrid between these cyclical sectors and growth sectors. And growth sectors include companies like the earnings certain portfolio. So the earnings certain portfolio of companies are members of the S&P 500, but alongside that index, you also get these sectors right here, which weigh on your results in the long term. Why? Because they introduce a lot of volatility and don't compound as quickly as the growth subset does. So these are companies that are mature, whose revenue earnings rise and fall with the broader economic cycle. They're highly sensitive to interest rates. They're highly sensitive to commodities prices, FX rates, et cetera. So they introduce a lot of volatility to the index. And they don't compound as quickly as the overall index does, because these are companies that have very poor ROIC, right? And that is, again, the reason why we always come back to that third idea here is we want consistency and attractive ROIC, because that gives you lower volatility, right? The consistency part of it reduces the volatility, and ROIC gets you better cumulative growth. The problem with financials and energy is that they have high volatility and low ROIC. That is the problem. And so we like to strip out that part of the S&P 500. And we like to focus on just the second, subset of the S&P 500, which is the growth subset. This is often called growth versus value, but we like to call it growth versus cyclical, because that's essentially what value stocks are, is that they are very, very cyclical. They rise and fall quite, rapidly with the broader economic cycle. That is the group of companies that we want to remove from our methodology. We want to avoid this type of volatility in earnings over time. Why? Because we are long-term buy and hold investors. And if you're a long-term buy and hold investor, it does not make sense to own cyclicals all the time. But that's exactly what you get if you are a long-term index investor. So these are the skeletons that kind of hide in the closet of the S&P 500 index. And this only adds value if you know how to time the market. Only if you are a macro analyst and you can forecast accurately when the bottom of the recession is in, and when the top of the bull cycle is in. If you know how to time that properly, then yes, adding these tactical tilts adds a tremendous amount of value. But if you don't know market timing, and if you're not good at macroeconomic forecasting, it really does not make sense to be an S&P 500 index investor, because you are forced to own these low ROIC, high volatility businesses. These are banks. These are energy companies. These are miners. These are materials companies. We'll take a look at some of those companies in just a minute here. And we want to focus on companies that are growing in a secular fashion, right? These are businesses whose managers continue to find new places to allocate capital for growth. And so therefore, there's a much lower correlation to the macro environment. So again, cyclicals represent a good opportunity during deep bear markets, right? It makes sense to own energy stocks or financials deep during recessions when they get very, very cheap relative to their normalized earnings growth. But if you are an index investor, you are forced to own them 100% of the time. That does not make any sense. So half of the S&P 500 index is comprised of low ROIC businesses that really don't grow much over time. They're basically cash cow businesses that churn out dividends because they don't really have many investment opportunities. So they don't really compound capital much at all. So that is exactly the type of business that we want to avoid in this entire strategy. But the secular growth companies is what we want to focus on. Companies that continuously reinvest cash flows and generate high returns. This is what achieves the compound growth effect, and that is the earnings certain portfolio. So this is the type of companies these are the types of companies that lurk in the S&P 500. We have Mosaic, we have Freeport-McMoRan, ExxonMobil, Citigroup. This is very, very high volatility, low ROIC businesses. They don't add a lot of value by being a long-term buy and hold investor, but they add tremendous value if you can time the tops and bottoms. That is exactly the type of, what's good for investors like Dan Druckenmiller, for example, one of the best, macro investors of all time. He can do this, but if you're not in that camp, it's very, very difficult to time these tops and bottoms. And, most investors, including myself, are simply not equipped to do that. So if you're an index investor, you've got these types of companies that are lurking in your portfolio. That's what you want to avoid. Whereas what we do to correct this mistake or correct, these drags on the portfolio is to invest in secular growth companies. Look at the difference in earnings growth over time. AmerisourceBergen, one of the biggest pharmaceutical services and distributors of the world. Amgen, one of the great success stories in biotech. Accenture, right? One of the foremost players in consulting, management consulting services. Ball Corp, right? These are secular compounders that continue to grow over time, despite recession, despite high interest rates, despite low interest rates, despite strong dollars, despite weak dollars, despite what's going on in terms of the flavor of the month or flavor of the year. These are companies that are quietly just executing long term, and their stock price really shows it over time. So, this is exactly the type of business we want to focus on: quality businesses, businesses that, whose management continues to reinvest cash flows back into themselves at a high ROIC, companies that, produce products and services that are always in demand. These are durable businesses, high quality businesses, high ROIC businesses, right? That's the triple canon to really, hone in on high quality. And so, this is exactly what we see here. The free cash flow return on investment. This is what we call cash ROIC, cash on cash return on invested capital. We consistently, almost always, in just about every single year, we produce excess ROIC each and every year. So the excess amount is what compounds over time. So this is what leads to faster growth and better capital allocation. And that's why, companies within the earnings certain portfolio, because of better capital allocation, because of better management and execution, they are often rewarded with a higher multiple, right? And so some people might shy away from that, saying that, well, you're paying high multiples for this group of companies. That's not the way that we should be thinking about it. That's, the reward for being high quality, right? And we know that there's a difference between, paying low multiples for, mediocre businesses versus higher multiples for exceptional businesses. Over time, even if you pay a high multiple for an exceptional business, you will outperform low multiple stocks that are very mediocre. And we've known that, and we've seen that, especially through, the letters that, Warren Buffett and Charlie Munger have authored over the years, through the Buffett annual shareholder meetings. They've talked about this ad nauseum over the decades, and that's exactly the philosophy and investment mindset that we want to follow, is just to focus on businesses who are durable and therefore produce consistent earnings growth, and whose managers, generate high ROIC and reinvest cash flows back, at that ROIC to then, compound capital over time. So again, the Earnings Certain Portfolio is a high long-term earnings visibility portfolio. So we like that long-term visibility, just like what we see here, consistency in earnings growth. That's highly visible earnings growth. They have high returns on invested capital. They have faster cumulative earnings growth. It is a low beta portfolio, again, because these are businesses who may not, have, the most eye-popping revenue growth, but because of that consistency and because of that recession resistancy, they have low beta characteristics to it. So they have lower price volatility along with that lower earnings volatility. And we really outperform during deep bear markets. We do underperform during bull markets. We're going to take a look at a little bit about performance in just a minute here. But we do underperform during strong bull markets, but we make up for all of those underperformance years with exceptional returns during bear markets. And we're seeing that, right now in 2022, and we saw that in 2008, 2009 as well. So over time, the Earnings Certain Portfolio historically, and we believe, going forward, will have better cumulative and risk-adjusted returns over a complete market cycle. The better total returns over a complete market cycle and better risk-adjusted returns over a complete market cycle. That is sort of the holy grail of long-term investing, and we think that we've got it with this portfolio. So let's take a look at the performance. Here is a little bit about the performance, and we can see, exactly how this portfolio is done. The cumulative returns, really speak for themselves here. Over time, and this is, investment results through May of 2022. And the excess returns per year have been about 3%. However, we do underperform during strong bull years. So during years where the S&P is up, we underperform the market by about 600 basis points, by about 6.3%. But we more than make up for it during the down, on down market years. So whenever the market is down, on average, we outperform by about 11.3%. So, in total, the annualized return of the portfolio versus the benchmark S&P 500 is in excess return of about 3.08%. So let's take a look at let's unpack that a little bit here. Sometimes you can beat the market over a complete market cycle, but with higher volatility. But let's take a look at that. We can see that we beat the market in terms of the average monthly return, roughly 1.02% is our monthly return versus 0.82 for the benchmark over the same time period. Again, this is going back from 2007 through May of 2022. We do better performance with less risk. You can see the standard deviation of the portfolio returns is about 3.74% per month versus 4.5% of the benchmark. So better returns, less volatility in terms of those monthly returns. So we have an R squared that is significantly better, the Sharpe ratio, which is significantly better at about 0.93 versus 0.57. Better returns cumulatively, less risk cumulatively, better risk-adjusted returns cumulatively over time. So this is exactly what we'd like to see in terms of the performance of the portfolio which goes along with the idea behind the portfolio, which is to look for companies that have durable businesses, they have economic moats or brand moats, businesses whose products are always in demand regardless of the macro situation, and managers who are running the business exceptionally well with high and attractive ROIC and sturdy ROIC over time. So let's take a look at some of the companies here. Let's unpack it and let's take a look at who is actually in the portfolio. And here is a sample. The overall portfolio is a group of 75 stocks. And here is just 9 of them, just to give you an idea of who they are. You can see that these are, many of them are iconic businesses: Costco, Autozone, Clorox, Disney. These are very, consumer-facing businesses, very, very iconic, very recognizable. Many of them have very, very strong brand recognition, like Clorox and Disney. These are, generational businesses that have been around for decades, if not more. Companies that have consistently delivered results over multiple decades of time, and who are, very, very likely to be able to continue that success going forward, given the size of the total addressable market that they operate in, and given what they are doing fundamentally to transform their business, if necessary, to changing, consumer tastes and, changing market dynamics as well as competition. Some of the other businesses are a little bit less, recognizable, like Toledo, Global Payments. Novo-Nordisk might be well known to quite many people here, as well as ICE. Not many people might know them, but everybody knows who the New York Stock Exchange is. So the Intercontinental Exchange, also known as ICE, that's their ticker symbol, owns the New York Stock Exchange, among other global market exchanges here. So these are businesses that have very, very strong moats. They have established themselves as leaders in their individual industries, and have really, really established themselves, and will continue, or very likely continue to do that going forward here. Amgen, let's just take a quick look. One of the great biotech success stories, 100x return since 1990. Very strong mix of mature cash cow drugs and many drugs in the pipeline within cancer and hematology. Total revenue across multiple areas of expertise is $26 billion on 85% gross margin. They've had a number of blockbuster drugs, including Enbrel at $4 billion in revenue this year. Prolia, Otezla, you might have seen commercials on Otezla. $2 billion in revenue expected this year. This treats a variety of different conditions such as rheumatoid arthritis, osteoporosis, and skin diseases like psoriasis. And they also have very, very exciting growth opportunities, and other programs in cancer and oncology. Very strong capital allocation. They do 10% returns on invested capital consistently over time. Very, very consistent over time. And shares remain very, very cheap at 14 times this year's earnings, despite high quality earnings. 25% free cash flow margin, 10% ROIC, and strong pipeline going forward. So again, this is the type of business we like to invest in. Look at the consistency in earnings growth over time. Now compare this to ExxonMobil. Like, which one would you rather own? Yes, ExxonMobil is doing great this year, but they've basically lagged for the past decade. If you were to buy Exxon 10 years ago, you'd just be breaking even right now. Whereas Amgen has, compounded and basically multiplied, over the past 10 years by, almost 5 times. So that has been a spectacular return for investors, and that's likely to continue because this is a business that continues to do quite well in terms of generating high ROIC and very, very consistent, and repeatable cash flows from their existing businesses and their existing drugs here. Novo-Nordisk, right? This is the global R&D and market share leader in diabetes management. As long as there's diabetes in the world, Novo-Nordisk is going to be here to stay. This is a company that is basically they produce insulin-based treatment, but also treatments in obesity and hemophilia. This is a blood clotting disorder. They have 50,000 employees globally, operating in 168 countries. It's just a massive operation. 34 million people rely on Novo-Nordisk products, of which 5 million are of low-income demographics. So, very, very strong foothold. This is the type of business we like. They are, they crush market share, and what they do exceptionally well. And, diabetes management will always be in need, regardless of what the Fed is doing or what, recession or no recession that we enter. Novo-Nordisk will continue to produce results year in and year out. So it's highly likely for those, that historical cash flow growth and earnings growth to continue. So this is exactly what that looks like. Long-term, just absolutely phenomenal, consistent long-term earnings growth. Again, exactly what we like to see, capital compound effect. You can see the ROIC here, just absolutely spectacular. They earn, for every dollar that they invest in their business, they generate 42 cents in profit. So that is just incredible versus, 11.5% for the S&P 500. So, head and shoulders above what the S&P is able to do. Costco, this really needs no introduction. Everyone knows Costco, 815 warehouses globally. They have a unique membership model, so that provides recurring revenue. There's almost 62 million paid members as of August 2021, and that has consistently grown, every single year, for the past several years here. And they've got 18% revenue growth, and it's just expected to continue. I mean, Costco has really established themselves quite well. They've competed really well with Walmart, but as we've seen here, the market for wholesale goods has remained very, very strong, despite multiple different environments that we've been in, and that's really expected to continue. And we've seen that over time. This is a chart that they provide on their 10K filing. For every new store that they establish, they have increasing sales per store. So you can see that that's related to their ROIC, because for every new store that they open, they're generating more and more revenue per new store. So they're getting better and better at store location selection, marketing, advertising. They're just getting better and more efficient as they go forward. So that is kind of contributing directly into why they generate, some of the best ROIC within retail. And you can see here at the very bottom here, they generate roughly 30% ROIC, which is very, very important, very good for, a brick and mortar retailer. Remember, they also generate really strong recurring high margin revenue from their membership. And so that really goes towards generating higher ROIC than traditional bricks and mortar businesses. So that's why Costco has just been able to generate just exceptional returns for shareholders, and that again is likely to continue going forward. Autozone, another major success story in the retail business. 6,600 stores in U.S., Mexico, and Brazil. 100,000 employees. I actually was shocked when I learned this. You'd never expect Autozone to be such a large employer, but they are. Remember, the bigger the number of employees, that actually kind of contributes to the moat that they have, because the bigger their headcount, the bigger the foothold that they have in their respective industries. There is a correlation between that. Not saying that it's a perfect correlation, but there is a correlation. The more employees you retain, the harder it is for competitors to crack into what you're doing. So AutoZone has just done exceptional with being the leading auto replacement parts and accessories retailer in the United States. They also have a private label. They also do auto diagnostics. That is software type revenue, so that brings in higher margins. They've been doing share buybacks consistently. They've actually repurchased almost 90% of all shares outstanding since 1998. We'd love to see that. Management really starting to position themselves for the EV revolution as well by selling EV chargers and home installation services. So very strong outlook going forward. And this is exactly what their earnings growth has looked like, which is absolutely phenomenal. Even during the 2008-2009 recession, even though auto sales took a big hit, their earnings didn't even budge. They didn't even flinch. And so that's why their share price really did not have as big of a drawdown as the broad market did, and it's because they have just exceptional, earnings growth and consistency here. So that is AutoZone. Clorox, another iconic brand. Won't go too much into it, but we all know what they do. Iconic household cleaning supplies brand, but they also own Armor All for automotive cleaning. They own Greenworks, as well as Burt's Bees. It's a higher end brand that they also own. They have 24 manufacturing in 24 countries, available in over 100 countries. This is among the strongest and most widely recognized brands. So this is a moat that is very, very difficult to beat, no matter who you are. Even if you are a Walmart, for example, your in-house brand has just been unable to dismount the market share leader, which is Clorox, and that's really projected to continue. We saw that they got a big bump because of COVID. This is simply the reversal of that, but we think that that's going to stabilize over time here. So Clorox remains, in our portfolio here again because of the long-term consistency that we think that that the business will return to after here. Global Payments is a little bit lesser known of a company, but this is a company that provides payment technology and business services to merchants globally. This company provides credit card processing services, point of sale solutions. They have over 4 million customers across 100 countries. So their customers are essentially retailers like Starbucks, Taco Bell, 7-Eleven, H&M, many more. And so they provide, again, credit card processing services, point of sale solutions. They provide sales and data analytics for merchants, so you can find out exactly what your sales trends are, what your margins are. You can manage your inventory, and you can get just overall smarter about, targeting certain customers. So you can understand exactly how often your customers repeat business. That's very, very important for retailers to understand, because if you have, high, customer retention, that means that you're doing quite a pretty good job. And if your retention starts to decline, that can give you a very early warning sign that, maybe that, there needs to be something that's done a little bit better. So it just provides and arms retailers with intel, which is very, very important, sales intel. So they have a very strong moat in the form of, high cost of switching. And therefore they, retain very high, they have very high retention rate among their clients, right? So this is your Starbucks, Taco Bell, 7-Eleven, and others. So again, this is a company that just, again, impeccable long-term results. Look at the growth of earnings over time here. So even through the 2008, 2009 recession, right? Even when retailers tanked in terms of their sales, remember, Global Payments is a SaaS business, right? They, generate recurring revenue in the form of subscription revenue to their clients. So this is highly recurring and it's highly visible going forward. And so we've seen this big drop off so far this year, but we're sticking with this company because of its, again, long-term, just impeccable long-term earnings growth and compounding effect that they've been able to pull off here. Disney, again, needs no introduction, the iconic American brand in entertainment, media, and lifestyle. They own ABC, Fox, ESPN, FX, National Geographic. And of course, they got into Disney Plus, which is their streaming service. We think that the Disney Plus streaming service, when it does start to contribute positive earnings, will actually make Disney even more earnings certain. So you see this huge drop off in earnings here. Obviously, this has to do with the COVID disruption. So, this chart doesn't look as good as some of the other companies that we have in the earnings certain portfolio, but this is, we're giving Disney a pass just because it's been very, very difficult. If you were forced to shut down your parks, of course, your earnings are going to take a massive hit. But we don't think that that's going to continue. That was sort of a black swan event that really, isn't expected to return anytime soon. Hopefully, knock on hardwood. But the growth of the Disney Plus service, once it does start to contribute, we think that's going to also increase the earnings certainty of Disney. And Intercontinental Exchange, right? This is another type of business that we love to focus in on. This is the leading global operator of regulated market exchanges, including the iconic New York Stock Exchange. They are the purveyor of global equity, fixed income, and mortgage data services. So what stronger moat could you possibly have than to be the market exchange, where the world comes to trade energy futures and commodity futures, right? That's ICE, right? There's a couple of others as well as in addition to ICE, but ICE is one of the most consistent, earnings growth stories. They delivered consistently 15% annualized growth over the past 15 years, even in including the turbulent market environment in 2008, 2009. Very strong ROIC backed by free cash flow growth. And here you can see the results over time. They've done, phenomenal. They've done an M&A sort of approach as well as organic growth over these years, but they are really jockeying themselves to be one of the dominant players in global regulated market exchanges, and that is unlikely to change anytime soon. Being the exchange is very, very difficult to be disrupted. So there's only a few market exchanges in the world, and ICE is one of them. And their big bet is also on mortgage data services too. So they are basically the purveyor of fixed income data as well as mortgage data. And so they earn very highly recurring, very visible recurring revenue in the form of subscription revenue that the world's asset managers rely on to conduct their business operations. So ICE is a very, very iconic business that will continue to generate strong results over time. And here you can see just very consistent earnings growth, and therefore look at the stock price returns over time. It's been very, very consistent. And you can see the distance between the stock price and the earnings line is almost the same over time. So it's a very consistent PE multiple over the past, really in the post 2009, Great Recession era, consistent results over time. So, hopefully this was helpful here. In a nutshell, this is a portfolio that we believe will, perform exceptionally well, especially during deep bear markets. But if you are a long-term investor, we believe that the investment approach of investing in quality will outperform the market in the long run. And that's exactly what we have delivered with this portfolio here, is that if we simply buy quality, and as long as we don't pay, abysmal multiples, which we've never really seen an example of that in the entire time that we've been managing the portfolio, then by simply doing nothing, you allow the compound effect to do its job, right? This is that compounding effect. Consistent earnings growth, consistent reinvestment, consistent high ROIC. That's what generates this type of, long-term earnings growth over time, which will trounce the S&P 500 average and therefore lead to better returns over time. That's what we believe will continue going forward, just like it has in the past. Again, because of our focus on, companies that are, essentially running durable business models, companies whose products and services will always be in demand, companies who are cutting costs for their customers, companies that increase utility for their customers or do something more efficiently for their customers, just businesses that are durable in nature by doing one of those three things, and businesses that have very strong economic or brand moats, right? These are the types of companies that we love to focus in on, and that is exactly how we will, attain and maintain excess returns over time. So hopefully you found this interesting. If you do have any questions, please do reach out to us. You can reach myself directly at this email address right here, zrs@zacks.com. If you are a ZRS client, again, zrs@zacks.com. If you are an advisor tool client, please do reach out to us at zat@zacks.com. And we definitely look forward to hearing from you, and hope to see you on the next one. Take care. Bye-bye.